You're watching Dukascopy TV. I'm Elaine Stenson. Consumer price inflation in the Eurozone held steady in November at a seasonally adjusted 0.9% last month, unchanged from an initial estimate and in line with expectations. The rate remains below the ECB's target of near but just below 2%. I'm joined on the line now by Steve Ruffley from Intertrader in the UK. Steve, the CPI figure we've seen, were you expecting this?
Well, CPI was pretty much in line with analysts' expectations. There was no surprises today. You have to remember that as traders, we're currently focusing on the growth figures, so the CPI and PPI really relate to inflation. And really, until we hear what the Fed have to say about proposing to stop or taper the quantitative easing tomorrow, this data is fairly irrelevant. So obviously, with the low interest rates, we know that inflation's been above target, around about 2% in the EU and the UK alike. But really, we've had to sacrifice this inflationary pressure to encourage growth. But I think everybody can safely say that the growth hasn't really come through. The growth we're seeing is really from, again, the consumers and people borrowing to stimulate the economy. We're not seeing the growth that we wanted from businesses. So really, in the EU, it's quite a mixed bag right now. I don't really think this CPI data is going to affect what happens in the market in the short term. In the long term, obviously, we know we're going to have to control the inflationary pressures, which is measured by the CPI and PPI. But really, until the Fed make a decision, I think we just have to really kind of wait and see. So today's CPI, bit of a non-event, I would say, in the Eurozone. How
much of an accurate reflection is this CPI figure of the bigger picture of the Eurozone's economic situation at the moment?
Well, I think the Eurozone is stable right now, and as stable as it's going to be. Unfortunately, in my opinion, the ECB and Mario Draghi, they're always last at the table with the important policy decisions. In my opinion, again, I think they've just been very, very guilty, as has Mark Carney to a certain extent in the UK, of just following the Fed. They've not really come out and made their own policies or stood apart. So real interest rates are going to remain low, but it doesn't matter. Anybody who knows anything about anything knows these things run in cycles, that although we're allowing interest rates to be artificially low to encourage growth, allow people to service the debt, this can't continue forever. So when interest rates do go up, which will be at some point in the next 18 months, we're going to experience the pain and everything that it comes with rising interest rates. So I guess everyone is doing their best to talk up the economy, again in the UK, the US and the Eurozone. But again, we're hearing crazy figures that, maybe the indices are going to outperform by 20%. I just don't see where this growth is going to come from. Again, a lot of this growth in the indices will probably come from speculation. And we all know what happened in gold. Gold got severely overpriced and then had a big sell-off. So that's my worry for the main European indices, that we just see speculation buying. My main concerns really all circle around the unemployment rate and the youth unemployment in places like Spain and Greece. You can massage the short-term figures, but these things are realistically going to take a generation to sort out. So nothing is going to fix itself quickly. So I think, for me personally, every major high we see in the indices over the next 12 to 18 months, I'm going to be shorting. The short-term picture we're not out of the woods, but it's not as bad as perhaps it could have been. But I think realistically, there's still a lot more pain in the European economy to come before we can safely say that the credit crunch and things are back to normal. That'll be my opinion.
And finally, Steve, you mentioned the Fed there. With regards with what happens tomorrow, how will this affect the Eurozone? What are you expecting?
Well, an interesting point. I mean, the Fed, again, have been very cautious about what they've said. They're more than aware of the implications, what will happen in the US and, across the pond in the Eurozone. I don't really think the Fed are going to do anything right now. I don't see why they would. I think they've pretty much, the market are pricing in there's going to be some sort of Fed taper in January or March. I don't think the Fed are brave enough to do anything before Christmas. But if they did, and the Fed did taper, it's basically a broad sell-off in all the main indices. We'll see the majority of indices, the DAX, the CAC, the SMI, all tumble and decrease, the depreciating value. That's just naturally what will happen. I don't really, again, it's difficult, as I was saying before, I don't really see the value right now in the markets in general being this high. They're only this high because of quantitative easing staying in place. As soon as that quantitative easing is tapered or removed to any extent, there won't be the emphasis in any market, be it European, be it US, to stay at these high levels. So naturally the markets will go down. But I don't think anything's going to happen before Christmas. I think realistically for me, I think the Fed are going to announce they will taper in January. I don't think they'll leave it till March. I think January, a new year, think the markets will be able to cope with that, but I don't see anything happening out of the ordinary tomorrow.
Steve, thanks for joining me on the line today, and that's all from me for now, but I will be back tomorrow with a press review. Until then, bye for now.